Today we are hosting a pay-per-view event inside your brokerage account, the Growth ETF Showdown. In the blue corner, the Celebrity of Tech Exposure, QQQ. In the red corner, the Mega Cap Heavyweight, MGK. In the sensible corner, with a coupon book and a spreadsheet, VUG. And in the stealth corner, quietly jacked and surprisingly cheap, SCHG. The goal is not to crown one ETF as the king of all time. The goal is to figure out which one wins for you, based on cost, diversification, concentration, and what you can actually stick with when the market decides to practice interpretive dance. Do me a favor and watch this one to the end, because I'm going to give you a dead simple pick the winner for your situation cheat sheet, plus the one mistake people make that turns a great growth ETF into an expensive stress hobby. Also, if you like investing content that is equal parts practical and mildly unhinged, hit like, subscribe, and let's get into it. We are doing 4 rounds: what each fund actually owns, what it costs, how concentrated it is, and which type of investor each one fits. Growth ETF usually means a fund that leans toward companies expected to grow revenue and earnings faster than the market. Translation: more tech, more consumer brands with cult followings, more companies that make you say, wait, they make how much money? Also, quick reminder, past performance is a receipt, not a guarantee. Growth can be amazing, but it can also feel like riding a scooter downhill with one tiny helmet sticker that says diversification. So we are going to focus on what each ETF is designed to do and how it behaves. Meet the contenders. 1. QQQ, the NASDAQ 100 Celebrity. QQQ tracks the NASDAQ 100, which is basically the biggest non-financial companies on the NASDAQ in one package. Think mega-cap tech and tech-adjacent giants. It is focused, it is spicy, and it has a reputation for showing up to the party with a leather jacket and a volatility chart. Costs matter, so keep this in mind. QQQ's expense ratio is about 0.18%, and it is extremely popular for a reason. You get concentrated exposure to some of the market's biggest growth engines, for better and for why is my account sweating? 5-year CAGR, compound annual growth rate, 15.20%. 2. MGK, the Mega Cap Growth Bodybuilder. MGK is Vanguard's Mega Cap growth approach. In plain English, it leans hard into the biggest, baddest growth companies. It tends to hold fewer names than a broad growth fund, which means the top holdings can carry the results, like a group project where only 3 people did the work. The fee is typically around 0.05%, which is low, and it is basically a mega cap growth greatest hits playlist. 5-year CAGR, compound annual growth rate, 13.70%. 3. VUG, the broad large cap growth workhorse. VUG tracks the CRSPUS Large Cap Growth Index. It is a broad U.S. large cap growth fund with a rock-bottom expense ratio of about 0.03%. That is not a typo. That is basically, Vanguard, please stop, my wallet is blushing. 5-year CAGR, compound annual growth rate, 13.36%. VUG is the friend who meal preps. It is not flashy, but it shows up every week. If you want growth exposure that is still diversified across a larger basket of big U.S. companies, VUG is often the set it and forget it pick. 4. SCHG, the low-cost challenger. SCHG tracks the Dow Jones U.S. Large Cap Growth Total Stock Market Index and charges about 0.04%. In other words, it is broad large cap growth exposure at a bargain price, and it has a lot of holdings. SCHG is the underdog in the movie montage. Not loud, not complicated, just quietly doing push-ups in the background while the other ETFs argue about who is more innovative. 5-year CAGR, compound annual growth rate, 13.76%. The Showdown. 4 rounds that actually matter. Round 1. Fees, aka, how much do you pay for the convenience? Fees are the tiny leak in the boat. One drip does not seem scary, but over decades, you are bailing with a coffee mug. QQQ, about 0.18%. MGK, about 0.05%. VUG, about 0.03%. SCHG, about 0.04%. Fee winner? VUG. Basically has the cheapest gym membership, but fees are not everything. Sometimes people pay more for QQQ because they specifically want NASDAQ 100 exposure and they want it in a single ticker. Round 2. Diversification, aka, how many eggs are in this basket? Diversification is not about owning 5,000 stocks so you can brag at parties. It is about avoiding the situation where 3 companies sneeze and your portfolio catches a cold. QQQ, around 100-ish holdings, because it is based on the NASDAQ 100. The fund can show slightly above 100 due to mechanics. MGK, typically a smaller list of mega-cap growth companies. As of March 31st, 2026, 64 companies. VUG, broader large-cap growth basket, 158 companies as of March 31st, 2026. SCHG, broad large-cap growth basket, about 196 holdings as of late April 30th, 2026. If you already own a total market fund and you want a concentrated growth satellite, QQQ or MGK can be that spicy side dish. If you want growth to be your main course, VUG or SCHG is usually the calmer plate. Round 3. Sector tilts, aka, surprise, it's mostly big tech. Let's be real. All 4 of these funds have major overlap in the biggest growth names. When people say growth, what they often mean is technology and friends. SCHG, for example, shows technology as its largest sector weight, with communication services and consumer cyclical next. Sector tilt matters because it changes how your ETF behaves. If tech is having a good year, your portfolio feels like it can bench press a car. If tech is having a bad year, your portfolio starts Googling how to become a value investor at 2 a.m. Round 4. Structure and practicality, aka, what will you actually hold? Here's the most underrated investing feature: sleep quality. The best ETF is the one you can hold through boring months and scary months. If you buy the spiciest fund and then sell at the first downturn, congratulations. You just turned long-term investing into subscription-based regret. Practical rule. If you already own a broad S&P 500 or total market fund, then adding one of these is mostly a tilt toward large-cap growth, especially mega-cap tech. That can be totally fine. Just know you are dialing the same knobs louder. Top 10 holdings. Weight. Concentration risk. QQQ. 46.96%. MGK, 65.67%. VUG, 63.87%. SCHG, 57.2%. Max drawdown, 5-year window. QQQ, minus 35.1%. MGK, minus 36.02%. VUG, minus 35.61%. SCHG, minus 34.59%. So, which one wins? Here's the truth. There is no single winner. There is a winner for a specific mission. If you want the NASDAQ 100 specifically, and you accept concentration risk, QQQ is the specialist. If you want mega-cap growth in a very concentrated form at a lower fee, MGK is the heavyweight. If you want a broad, low-cost, core large-cap growth ETF, VUG is the classic workhorse. If you want a similar broad, large-cap growth core, also very cheap, from Schwab, SCHG is the stealth value in fees pick. Total return metrics as of April 2026. Source, financecharts.com. QQQ. Year-to-date, 9.88%. 1 year, 40.64%. 3 year, 112.95%. 5 year, 106.64%. 10 year, 579.01%. MGK. Year-to-date, 1.84%. 1 year, 33.65%. 3 year, 104.78%. 5 year, 93.98%. 10 year, 446.20%. VUG. Year-to-date, 3.25%. 1 year, 31.66%. 3 year, 103.03%. 5 year, 89.28%. 10 year, 413.06%. SCHG. Year-to-date, 1.01%. 1 year, 30.00%. 3 year, 102.01%. 5 year, 92.92%. 10 year, 437.22%. The real champion is the investor who picks a simple plan and sticks to it. You do not need the perfect ETF. You need a good ETF, an automatic contribution schedule, and the emotional stability to not rage quit your strategy because a headline used the word plunge. Example setups. Optional ideas, not advice. Simple Growth Core. VUG or SCHG as your growth sleeve, paired with a broad market or S&P 500 fund for balance. Core plus satellite. Broad market core plus a smaller allocation to QQQ or QQQM if you want extra NASDAQ 100 tilt. Mega cap tilt. Broad market core plus MGK if you want to lean harder into the largest growth names. Final takeaway. Investing is not about finding the one magical ticker that makes you rich overnight. It is about building a repeatable system that future you will thank you for. Pick a fund you understand, keep fees reasonable, stay diversified enough to sleep, and then give compounding the time to cook. If this video helped you, do me a favor. Hit like, share it with a friend who's into investing, and subscribe for more money truth with less money stress. If you want a step-by-step guide you can actually use, check out my books, The Wealth Basics, a practical guide to investing and building generational wealth, The Stuff We Should Have Learned in High School, and AI Meets Finance, Investing in the Age of Artificial Intelligence. They're available on Amazon, and the links are in the description. Now, watch the next video on your screen. Thanks for your support. I'll see you in the next one.